The 15th largest bank in the United States is going through a Fed-induced recession, which is causing a massive bank run from billion-dollar firms all the way down to small business checking accounts. And this could actually cause this bank to completely go under. Now, if that sounds bad, then you are starting to now understand the severity of the situation, because again, this is just the 15th largest bank, and it is called Silicon Valley Bank. It's out of Santa Clara, California. But here's the truth. The fact is that the 15th largest bank in the United States is collapsing. It is actually causing the American people to go to the smaller banks and start pulling money out. Yes, you are FDIC insured for up to $250,000, but that doesn't mean the U.S. government, when the bank goes under, is just going to give you $250,000 or whatever it is that you had in the bank. They can't do that. They don't have that kind of money. And this is why more and more people are heading to their banks and pulling cash out. This is why we're seeing a massive bank run. And I've been saying this for a while, that this happened over in Europe. We knew that, and that's why I reported on when it was happening, is because when it happened in Europe, there was a chance we could see something very similar happen here in the United States. Guess what? It's happening. Now, let me tell you this. If you wanted to take your money out of the Silicon Valley Bank, you can't. They are going to have some money available come Monday, but you can't take it out today. And if everybody goes to the bank on Monday to get their money out, guess what? They probably are not going to have it for every single person because they don't have that kind of money. But if you're worried that the bank is going to go under, well, guess what? Your worries are justified because this is probably what's going to happen. The truth is that if you go to any bank, it doesn't matter if it's the Silicon Valley Bank, you could go to your local Chase Bank. And if you try to pull out $10,000 in cash without giving them a heads up, probably at least 24 hours before, there's a good chance they will not be able to give you $10,000 in cash. Maybe not even $2,500 in a single day. But it doesn't stop there. Okay, that's just what most banks do. Here's what you need to keep in mind. The Silicon Valley banking situation is just the beginning. Because now we are hearing from Wall Street that they are worried that there will be a financial crisis that rivals that of the 2008 financial crisis. Only this time, they say it's going to be worse. We're already seeing the stock market sell off. We're expecting housing to plummet. The amount of people working, yes, is increasing, but at the same time, the available jobs are starting to go away. But the fact is that the U.S. government doesn't have the money. Yet investors are already asking the U.S. government to bail out these banks that are struggling financially. Why would they do that? Well, the reason why investors want the U.S. government to bail out a bank if it's struggling financially is because that could start to spread. That could spread to other banks. This truly is a massive turning point in the U.S. economy, and we have known this, that this is likely to happen. And guess what? It is now started. But let me explain why all this is happening and what you should be doing about it. First, let me start there. What should you do? Well, this isn't financial advice from me, but according to financial experts, they say the best advice they have ever given is to stay diversified, especially in tough economic times, which I think we can all agree this is a tough economic time. And if you agree with that, go ahead, hit the like button on this video. Now, here's something else they say. Financial experts recommend you never invest into small amount of companies. You need to stay diversified. Never keep all your money in a single bank. Spread it around and protect yourself. That is what they're saying. So again, it's not financial advice from me, but that's good advice from financial experts, is to diversify and protect yourself in case something were to happen. But here's what's going on. The contagion is spreading. First, let me address why banks could be in trouble and why this is a Fed-induced recession or Fed-induced problem. The issue with banks is banks collect their money, collect money from customers. This is how banks make money. They collect money from customers. They take that money and they invest it into things. It could be bonds or businesses, mortgages, and so on, right? But here's the problem. Some bonds, for example, short-term bonds, 6 months or shorter, they would put their money into those. And when a bank invests into those, they will yield a return after 6 months. So get the money that they invested plus a little bit extra in interest. They'll get that and it won't be tied up. But the scary investments are mortgages, because mortgages in most cases are 10, 15, 30 years. So here's the issue. As interest rates rise, which the Federal Reserve has been doing very consistently for about the past year, as rates rise, the value of the bond drops. And when you look at the bank's balance sheet, for example, you have losses or unrealized losses. And when you see this, and again, this is happening right now. So what happens is these banks are needing to raise more money in order to give their customers, again, especially if we're having a bank run, right? They need to, pay their obligations, their debts. Well, guess what? If they have to sell what they call an asset, but the asset has lost value, well, they could potentially be selling at a loss. So here's the big worry. The 15th largest bank is feeling the heat because of this. So is the rest of the banking world. In fact, just yesterday, I believe we saw I think it was like $80 or $90 billion in losses to the banking market cap. Just went away. It was gone in just one day, a single day. But now we have people like Peter Thiel. He's telling his clients to pull their money from Silicon Valley Bank. And this is important to understand, because when the bank has to sell their upside down assets, they lose money. And if they lose enough money, they won't be able to pay their own debts. And when this happens, the ones that get hurt the most are the bigger banks, right? The Goldman Sachs, the JP Morgan Chase, those ones. Those are the ones that get hurt the most. Now listen to this. Financial experts are extremely worried about this upcoming year for real estate. They say we're already having issues, but real estate is only going to make this worse. They say that the people who took out adjustable rate mortgages and mortgages that they really couldn't afford, they're going to get smacked. That's what they're saying. But here's the truth. The truth is that when these borrowers can't pay their debts, the banks are going to be the ones that get smacked. The banks aren't going to they're going to be holding a potential asset, or technically a debt, because they have to service the house. They have to ensure that there's running water, there's electricity, especially if we are in the middle of winter. The banks have to pay this. They have to pay to ensure that the house has water and electricity so the pipes don't freeze, right? They have to keep the house heated, right? That costs money. And it could be money that the bank doesn't have. So the bank is going to take on a home. They'll foreclose on homes that people can't afford because the interest rate was too high. So they can't afford it. They take the home back. Now they have to pay this monthly recurring cost because, again, nobody's in it. Nobody's taking on this debt, right? Again, rates are so high. Who's going to be buying a home, especially one that potentially has been run down, unless the banks can give them a deal? And according to experts, this is what is likely to cause another situation that is similar, if not worse, than that of 2008. So again, be ready for what is coming, because this will not be good. And I bring this up because it is just now starting. There's a massive bank run that's happening now. Your money isn't safe in 2023. You want to put it in the stock market? Well, I can tell you this. For most people, if they stuck it in the stock market, let's say Monday, for one, they lost money. They lost money this week. And next week, we're going to have the CPI report. Guess what? A lot of people are worried that they're going to lose more money. There's been a massive amount of selling. I talked to a handful of people just today. Everybody's selling. Everybody's selling because they started buying in over the past couple of weeks. Guess what? Over the past couple of weeks, where it slowly went up and then it came back down even further, slowly went back up and then came back down even further, that's not a good cycle. You're going to lose money. And again, not financial advice, but if this is just starting now and there's a massive bank run happening right now, maybe the best thing to do is sit back and wait. Wait for this to blow over. Okay? Yes, having money sitting in the bank or sitting under your mattress or in a cushion on your couch, probably not the best thing to do because it's not going to yield you a return. But at the same time, it's not going to lose you any money. Well, technically. Essentially, you're still going to be behind inflation, so your money's going to be worth less, but you're not going to lose it. So we will see what happens, but let me know what your thoughts are. Do you think other banks are going to follow in the footsteps of the Silicon Valley Bank? Do you think they're going to go bankrupt? Because according to a lot of experts, they say it's going to happen, and it could potentially be worse than 2008. So again, if you have any questions, please ask your questions down in the comment section below. All I ask is if you can spend just 2 seconds, go ahead, hit that like button for the YouTube algorithm, and I'll see you guys on the next one.